Okay, welcome everyone. There are 22 of our friends joined, so 21. Let's start, and hopefully the rest will join soon. Can you please anyone confirm that you can hear my voice and also can see the screen?
Yes, can sir.
Okay, thank you very much. Okay, today is our revision class, actually, a revision for test 2. So we'll do 2 exercises, multiple of them. I'll show you the exercise and also the solution. This file is already uploaded on Canvas. You can download it and repeat the similar examples. And just my suggestion is try to follow the format that I have used to draw the solutions. In the test, you will have 2 questions. These 2 questions, one is from capital budgeting, the other one is from the hedging solutions, and you will have to answer 1 question. Okay, so let's go with this first, and then if you have question, you can email me on the test. If you have any question, you can email me. I'll try to answer those questions as soon as I can. Our test is next week, so you will have 1 week time to prepare yourself. The first example is a capital budgeting example on Wolverine Incorporation. It's an American company. So this is a US-based company, Wolverine. It's a capital budgeting example. It currently has no existing business in New Zealand, so they're possibly planning a subsidiary in New Zealand, but is considering establishing a subsidiary there. So they're considering establishing a new subsidiary. They have no operation, so a new subsidiary in New Zealand. The following information has been gathered to assess this project. So the information is given. Based on information, you have to prepare a capital budgeting project report. The initial investment required is 50 million in New Zealand dollars. Given the existing spot rate of 0.50 New Zealand per dollar, the initial investment in US dollar is 25 million. In addition to $50 million New Zealand initial investment for plant and equipment, there are New Zealand dollar 20 million is needed for working capital. So you need a working capital of $20 million and will be borrowed by the subsidiary from a New Zealand bank. Okay, it's a borrowing. It's not given by the mother company. It's a borrowing by the subsidiary from a New Zealand bank. The New Zealand subsidiary will pay interest only on the loan each year, at an interest rate of 14%. The loan principal is to be paid in 10 years. So the principal amount will be paid in 10 years time, whereas the interest will be paid every year basis, and the rate of interest is 14%. Project will be terminated at the end of year 3. So the project is for 3-year time. When the subsidiary will be sold, the price, demand, and variable cost information for New Zealand are as follows. So they have given you year-wise, first year, second year, third year price per unit, and the demand, how many units they are going to sell, and the variable cost. Oops. So these items are written here. You just have to take note of them. You will need them later on when you are doing the calculation. The fixed costs, such as the overhead cost, are estimated to be New Zealand dollar 6 million per year. The exchange rate of New Zealand dollar is expected to be in the future 0.52 at the end of year 1, 0.54 at the end of year 2, and 0.56 at the end of year 3. So they have already given you the exchange rate. You don't need to calculate it. Remember in the previous exercise, we calculated exchange rate. Here you don't need to. They have already forecasted exchange rate for you. The New Zealand government will impose an income tax rate of 30% on income. In addition, it will be imposing a withholding tax of 10%. Remember the withholding tax, when you are transferring money from subsidiary to parent company, you will have to pay withholding tax. So this is 10% for New Zealand case. If your earnings are remitted, you will have to pay this 10%. The US government will allow a tax credit. If you are paying this 30% tax rate in New Zealand, when you transfer the money to US, you don't have to pay a tax again in the US. They will allow you, US government will allow you a tax credit. This is a bilateral tax credit between New Zealand and US government. If any subsidiary of a US company has already paid enough tax in the subsidiary location, they don't have to pay tax again in the US. So they call it a bilateral tax credit. So this is a tax credit given by the US government, meaning that on your remitted income to the US every year, you don't have to pay any tax. All cash flows received by the subsidiary are to be sent to the parent. So you are going to send everything to the parent at the end of each year. So every year, all income will be transferred to the parent company. The subsidiary will use its working capital to support ongoing operation. The plant and equipment are depreciated over 10 years using the straight line depreciation method. So you use plant and machineries to be depreciated for 10 years period. Since the plant and equipment are initially valued at New Zealand $50 million, the annual depreciation expense is New Zealand $5 million. So they have given you calculated all figures already. Okay, $50 million is the New Zealand annual depreciation cost. You just need to consider this in your calculation. In 3 years, the subsidiary is to be sold. Wolverine plans to let the acquiring firm assume the existing New Zealand loan. So the New Zealand loan, remember the loan is taken for 10 years. Only 3 years will be paid by the subsidiary. The remaining loan will be taken over by the new company that is purchasing the company. The working capital will not be liquidated. This is a very important information. The working capital will not be liquidated, but will be used by the acquiring firm when it sells the subsidiary. So when the parent company sells the subsidiary to the new company that is buying the subsidiary in New Zealand, the working capital, remember New Zealand $20 million that you started with, that amount will not be liquidated. That amount will continue. I'll show you what is the difference between liquidated and not liquidated later on when we do the solution. Wolverine expects to receive New Zealand $52 million after subtracting capital gain taxes. So when they sell the company to another company after 3 years, Wolverine is expecting that they will receive $52 million from after subtracting any kind of taxes given to New Zealand government for selling the project to another company. So this is the salvage value. Remember the salvage value. This is our salvage value. Assume that this amount is not subject to withholding tax. Wolverine requests 20% rate of return on this project. So the cost of capital K is 20% on this project. So you don't need to calculate cost of capital, don't need to calculate many of these things. These are already given in the question. What you have to do is prepare a report that analyzes financial prospects for both the parent as well as the subsidiary. Decide based on parent perspective whether to accept or reject the project. And then question 2 is assume Wolverine used the original financing proposal that funds are blocked until the subsidiary is sold. That funds are blocked, meaning that you cannot send any funds to your country. These are blocked until the subsidiary is sold. Funds to be remitted are reinvested. Funds to be remitted are reinvested at a rate of 6%. Remember the previous example we have done? You can reinvest in Malaysian market, remember? So this one you can reinvest in Singapore market, New Zealand market at 6% rate after taxes until the end of the year 3. So until the year end of operation, you can reinvest your income at 6% rate after tax. How is the project's NPV affected? So how your decision in question number 1 is changed if this alteration is if this alternative is considered. Okay, so I'll give you 1 minute time, 1 or 2 minutes time. Go through the question again. Most of the calculations are already done. Most of the tricky parts they have already calculated for us. Just one additional component is question number 2 that we will separately show you. And there are some puzzling words here and there. One of the puzzling word is liquidated. The working capital will be liquidated. This is a puzzling word. We'll try to go through them and we'll try to solve them step by step. So let's take 2 minutes time. See whether there's anything that pops up. Okay, so let's now look at the solution. This is a suggested solution for the example that we are trying to take now. As you can see, the first thing you need to identify the number of years. First of all, year 1, year 2, year 3, and year 0. So first thing you do is you'll identify number of years. Okay, my marker is not working, so please follow my mouse, or the file is already uploaded, so you can follow that as well. I took a screenshot of the solution and uploaded there. Also, as you can see, they followed a slightly different structure, but you can follow my previous format as well. Format is still same, it's just that they are putting the initial investment here, at the bottom, so that they can easily do the calculation. And you can also put the initial investment at the top. Now, let's start at the bottom first. So the initial investment by the parent company is $25 million US. We already know about this. This is already given. And there are the second part is the incremental operating cash flow, or the operating cash flow. So operating cash flow is basically your sales, starting with your sales. It's basically your income statement. So it's starting with demand, then price per unit, then total revenue, then variable cost, fixed cost, and all other items step by step. So the items are already given there. You can go through the table, the items are already given. After the fixed cost, you have interest expense. Remember the loan amount, so 14%. You are taking loan of 20 million, so 20 million multiplied by 14% is 2.8 million. So you're giving 2.8 million, 2.8 million, 2.8 million in 3 years. The remaining will be taken over by the new company that is purchasing your project after year 3. Non-cash expense depreciation, remember 5 million. So 50 million divided by 10 years, 5 million each year. Total expense is calculated, summation of all these figures. Then you have before tax earnings of the subsidiary, and host government tax is 30% in New Zealand. So you will deduct 30% tax. After tax income is 3.5, and net cash flow to subsidiary would be 8.5, is basically 3.5 plus depreciation. Net income plus depreciation. So 3.5 million plus 5 million is 8.5 million. And then you will decide how much money you can transfer. So the first proposal is New Zealand subsidiary can remit 100% of the cash flow. So 8.5 million, 12 million, and 15.920 million. This entire amount you can transfer to the parent company. The withholding tax imposed is 10%, so you'll deduct 10% out of it. 8.5 million, 10% is 850,000. For 1.2 million for 12 million, 1.592 million for 15.92 million. After deducting withholding tax, you have the New Zealand dollar that you are ready to remit. So 7.650, 10.8, and 14.328. The salvage value, remember the salvage value is already given. Salvage value is 52. Okay, salvage value is 52 million. It's already given. The reason why they have deducted withholding tax before salvage value, because it's written in the question that on this salvage value you don't have to pay any withholding tax. So they have calculated withholding tax first and then showed the salvage value. Okay, and the next one is the exchange rate. You will use the exchange rate given already to calculate what is the transferred value to parent. So the parent company is in US. Now the value is transferring to US dollar. After 0.52, it is 3.978. 0.54 is 5.832, and 0.56 is, after considering all cash flows, is 37.143. The present value of the cash flow at 20% discount rate, you will deduct cash flow divided by 1 plus k to the power t. So cash flow is 3.978 divided by 1 plus k is 20%, 1.120 to the power 1. 5.832 divided by 1.20 to the power 2. 37.143 divided by 1.20 to the power 3. By this way, you calculate the present values. And then the initial investment is 25 million in US dollar, and the present values are 21. These are basically cumulative. These are cumulative cash flows. So you have the negative or cash outflow, and these are positive cash inflow. So they have calculated the cumulative to show you what is the positive NPV. The positive NPV is 3.860 million. So in the third year, the company is going to earn positive, which is more than the initial investment of 25 million. It means that the company's NPV, net present value, is 3.860185. It's a good investment. It's a positive NPV investment, and we suggest that based on the parent company analysis, the company can accept this project. This is a good investment project. You might be thinking that why we did not analyze the NPV for subsidiary, because in the question they already told that we will only consider the cash flow for the parent company. We are deciding based on the parent company. Let me show you this. Prepare a report. Look at the question number 1. Prepare a report that analyzes financial prospect, both the parent as well as subsidiary, but decide based on parent perspective. So your decision, NPV and other calculations will be based on parent company only. That's why the here only NPV calculated based on parent company, not the subsidiary. In the previous class, the example that we took there we calculated NPV for both parent company and also for subsidiary. Okay, so this is a small explanation given here. Keeping other things constant, the primary decision criteria in this scenario following the net present value method is to achieve a positive NPV. The net present value of this project is 3.860185. Therefore, Wolverine would accept this project. However, the decision may change due to various factors. Company have to carefully consider the risk of the project due to changes in political and business scenario in subsidiary as well as parent company. Changes in political risk may change the policies governing business operation, tax rates, and policies on remittance of cash flows. So these are the factors that you need to consider while you are writing a summary for this question. The second part of the question was the blocked fund. If the fund is blocked and you are allowed to save it for until year 3, and you will earn, let me check, you will earn at 6%, reinvested at 6%. Okay, so if you are earning at 6% and investing in New Zealand market, which will be transferred all together in the year 3 to US, what happens to our cash flow? So you have net cash flow to subsidiary. You have calculated that this is 8.5, 12, and 15.92. Okay, and then you have investments that you are planning to do investments, and these investments are 6% investment. So year 1 investment will be invested for 2 years, year 2 and year 3. Year 2 investment will be invested for 1 year, which is for year 3 only. And year 3 investment will not grow, it will be as it is, 15.92. Okay, so they have shown the year 1 at the last, at the bottom, year 2 at the second one, and the first one is year 3. So New Zealand remitted by the New Zealand dollar remitted by the subsidiary. First year there is no remittance, blocked. Second year no remittance, blocked. Third year they will transfer all together, 38.190. And on this, the withholding tax imposed on the remitted fund is 3.819. The New Zealand dollar remitted after withholding tax is 34.371. The salvage value, which is not subject to the withholding tax, is now placed here, 52 million. This is US dollar. New Zealand dollar exchange rate for the last year only 0.56. So after converting, we have cash flow to the parent company is 48.368. Present value is calculated using 20% discount rate is cash flow divided by 1.20 to the power 3 is first year 0, to the power 1 is 0, no cash flow, to the power 2 is 0, no cash flow, and the third year to the power 3 is 48.368 divided by 1.20 to the power 3 is 27,990,777. And we have our initial cash flow, which is cash outflow 25 million minus, you can see. So after calculating cumulative cash flow, or you can add them all together, deduct it from 25 million, we get 2.990,777. Now you can compare this with the previous NPV, which is 3.860. Obviously, in the first project, NPV is higher. So you can now decide based on this calculation whether the company is going to invest it and then transfer, or the company is going to transfer it every year. Now, there is a tricky part here. This blockage of fund is basically a risk for the company. So if the company see that their NPV is dropping from almost 3.8 million to 2.9 million or almost 3 million. So it means that your NPV is dropping because of this blockage of fund. So this is a risk. This is a major risk. So you now need to decide whether you will come to this country or not, whether you will invest in Singapore, in New Zealand or not. You need to carefully consider this because of the restriction. your net present value is dropping. If it was same or still increasing, then you may consider. But since this is a negative value, this is a positive value, still you can accept the project by the rule. But because of blockage of fund, your risk is increasing, and your value of the cash flow is also decreasing. So you may or may not invest in New Zealand because of this additional action taken by the New Zealand government. So this is question number 1, Wolverine. Let's move on. We have a transaction exposure here, but we will do this later. We do another capital budgeting, then we'll come back to the transaction exposure. Okay, so that we maintain some similarity with our examples. So this is another company. Let's take this example, then we'll take a break, and we'll do the transaction exposure after the break. This company's name is Beta Incorporation. So from the name, you can guess that possibly they are also a US company, and they are possibly planning to invest in another market. So Beta Incorporation has recently introduced a 3D mobile device for communication. I'm not sure whether we have done this example already or not, but in any case, this will be an experience. Beta has decided to conduct an analysis on Malaysian market, okay, whether they want to invest or not. The company will initially produce mobile phones and distribute these to local market. An initial investment of RM 500 million has been estimated. It includes purchase of an existing mobile phone, and this is RM 500 million. Okay, they are purchasing. They are not entirely introducing a new subsidiary. Okay, they are only purchasing an existing operation, and they are purchasing it for due mobile SD and BHD. Working capital of RM 30 million is considered, and a factory modification cost of RM 70 million is considered. Look at this first paragraph for 1 minute. What are the items involved in the initial investment? Okay, so let us repeat again. What are the items involved? 500 million for the initial investment. You will have 30 million for working capital and 70 million for modification cost. Okay, let's move on. Beta Incorporation signed a MOU with the government of Malaysia. According to this agreement, Beta Incorporation will produce and sell phones from its facility for 4 years. So the project is for 4 years. Will sell the setup to the government of Malaysia at the end of the operation. So government of Malaysia will purchase this operation at the end of 4 years. On another note, Beta Incorporation will enjoy a special tax rates for the next 4 years. The tax rate on Malaysian earnings for Beta Incorporation was agreed to be 20%. So maybe it's a reduced tax rate for offered to this company. There will be no tax on the subsidiary income when the income is repatriated to the parent company in the US. So there is no withholding tax. This is another benefit. To employ the reduced tax rate, the government of Malaysia gave 2 conditions. Okay, so it's not free. Malaysia has given 2 conditions. Malaysian subsidiary Beta Incorporation can transfer 30%, 50%, 70%, and 100% of its income after tax to the parent company each year, respectively, in the next 4 years. So in the first year, you can transfer 30%. In the second year, 50%. In the third year, 70%, and the fourth year, you can transfer 100%. The remaining in each year can be reinvested at 8% simple interest rate per annum in local bank. So there is a reinvestment proposal. So in the first year, 30% can be sent, 70% should be reinvested. In the second year, 50% should be sent, 50% should be reinvested. In the third year, 70% should be sent, 30% should be reinvested. And in the fourth year, you can send all of them back. The accumulated figure of the investment and interest will be remitted to the parent company at the end of operation. Secondly, the second condition, Beta Incorporation has to pay 10% withholding tax while remitting the income to the parent company. Okay, so option, these are options. So first option, you don't need to pay any withholding tax. The second option is, if you do not follow the first option, you will pay 10% withholding tax. Pre-tax earnings, so you don't need to start from sales. They are going to give you some help here. Pre-tax earnings after depreciation per annum have been estimated to be RM 160 million in the first year. So this is for the first year only. The earnings are estimated to increase at 20%. This will increase by 20% every year for the remaining 3 years. So for second year, third year, and fourth year, for these 3 years, earnings will increase by 20%. Company is planning to use MACRS, a depreciation method. MACRS, okay. Previously we have done straight line. This is called MACRS, M-A-C-R-S. MACRS is Modified Accelerated Cost Recovery System. Modified Accelerated Cost Recovery System. Let me see whether I can open a text box and write it here. So MACRS is Modified Accelerated Cost Recovery System. Okay, so the difference between MACRS and straight line is that when you do straight line, you divide by number of years. Remember, in the previous case, 50 million was the planned cost divided by 10 years. So you have 5 million per year, right? So in a straight line method, you are giving similar weight, same weight to every year. Every year is 10%, or every year 20%, something like this. But in MACRS, you give different weights. You give different percentage, different year. And this MACRS depreciation system is official system, and the percentage for each year is based on asset class, and it is decided, publicly decided. You cannot decide on your own. It's available on MACRS website. Okay, it follows a normal distribution. So I will show you later how the rates go on. I think it's given here. You can see the MACRS depreciation. The depreciation method, the rate of depreciation each year is given. For the next 4 years will be 20% first year, 30% second year, 22% third year, and 18% in the fourth year. Okay, it may not be equal to 100%. It may not be equal to 100%. Okay, 22% plus 18% is 40. 40 plus 30 is 70%. 70 plus 20 is 90%. So another 10% is the book value. Okay, 90%, 20 plus 30 plus 22 plus 18 is 90%. Another 10% of the asset is book value, meaning that in 4 years, the asset will not be fully depreciated. In 4 years, asset will not be fully depreciated. Another 10% will be remaining. That 10% will be book value. So the difference between MACRS and straight line is, in straight line, you will have same rate, 20%, 20%, 20%, 20%, 20%, right? It's a similar way. In MACRS, there will be different rate in different year, and it follows a normal distribution. You see, it's growing from 20 to 30, it's growing up, then it's coming down 22%, 18%. So it follows a normal distribution. The government of Malaysia has agreed. The government of Malaysia has agreed to buy the plant at the book value at the end of 4 years. So at the end of 4 years, 10%, book value is 10%. 10% at 10% value, Malaysian government will purchase the project from the company, from Beta Incorporation. The spot rate for Malaysian ringgit to US dollar is given. The spot rate is given is USD 1 for Malaysian ringgit 3. That must be very, very long time ago. Inflation rate in the United States is 2% this year, and this rate is expected to remain the same for the next 4 years. Okay, for the next 4 years, inflation rate in the US is same. The Malaysian inflation rate, however, is expected to change. The present rate is 2%. It will be 3%, 4%, and 5% each year, respectively, in the next 4 years. So Malaysian inflation rate will increase, meaning that Malaysian currency will be depreciated. Beta Incorporation stock is having a beta of 1.25. Oh, now additional information given. So these companies stock beta is 1.25. The risk-free rate of return is 5%. KRF is 5%. The return of the market is 17%. A risk premium of 2% should be considered while evaluating Malaysian operation. So you need to adjust Malaysian operation with 2% risk premium, meaning that Malaysian operation is risky and that the value of that risk is 2% additional cost. The rates are expected to remain constant throughout the duration of the project. So you need to calculate this information. The last paragraph is given for calculating cost of capital. If you cannot calculate cost of capital, you cannot calculate NPV. So you need to use CAPM, capital asset pricing model, to calculate the cost of capital of this project. Okay, so what we do now is prepare a report combining financial issues involved in this proposal to make an informed decision by Beta's management. Your report should comment upon the financial viability of the project to the parent as well as to the subsidiary. So you need to do analysis both for the parent and for the subsidiary. So we'll go with the solution first, see how it goes. First of all is the initial investment. So what we always do, you see, what we always do, the first thing is we identify the year. You can see at the first line, identify the year 0, year 1, year 2, year 3, year 4. The first thing we do is we identify the year and then we start identifying the cash flow. In the 0 year, we have the initial investment. You can see the planned cost is total initial investment is 500 million, right? So from 500 million, they said working capital is 30 million and modification cost is 70 million. So 500 million total, 30 million working capital, modification cost is 70. So the net planned cost is 400 million. So be very careful. The initial investment, total initial investment is 500 million. It's not the planned cost 500 million. So be very careful. So don't put planned cost 500 million, then modification cost 70, and then working capital 30. So total initial investment is 500 million, and the modification and working capital is already inclusive of this 500 million. Next, go to the operating cash flow. In the operating cash flow, you have pre-tax earnings given for each year. I will only refer to the first year, then we will just repeat the second and third and fourth year. Post-government tax is 20% in Malaysia, so you deduct the tax. After-tax earnings for the subsidiary is calculated by deducting 160 minus 32. And then we have depreciation calculated. Remember depreciation, each year there is a different rate, right? First year is 20%. Now, how you calculate depreciation? Let me see whether I've given any note here. No, I have not given any note. So we need to show this calculation here. Now, we are not going to calculate depreciation. Let me make it a little bit bigger. Okay, we are not going to calculate the depreciation on initial investment. Okay, not on initial investment, because the initial investment includes the working capital as well. So what we need to do is we need to consider obviously the plant. Okay, then we need to consider the modification cost as well. The modification cost will help you to modify your machine, and after modification, the entire modified machine will be considered for depreciation. So plant plus modification cost is 470, and you will consider this value for depreciation. Let me do the calculation and see how it goes. So 470 million total multiplied by 20% is 94 million. You see the depreciation cost is 94. Hello, can you hear me? Anyone please confirm?
Yes, sir.
Okay, there might be an internet issue. Okay, so once again, when we are calculating the depreciation, we will do the planned cost. Planned cost will automatically be considered in depreciation. You just need to be careful. Add modification cost. Do not add working capital. We do not calculate depreciation cost on working capital. Okay, what other costs might be considered? For example, there might be a cost on shipping cost, transportation cost, transportation for the plant. Let's say you are bringing a machine from outside, so that transportation cost will not be considered into depreciation because transportation cost is not part of the machine itself. But the modification cost changes the structure of the machine. So you need to consider the modification cost for depreciation. So 470 million multiplied by 20% is 94. Then multiply with the second figure, you'll get the second year, third year, and the fourth year depreciation cost. After depreciation, you have net income. After net income, net operating cash flow, okay, is after tax plus depreciation. So all together here. So you are deducting before tax subsidiary minus the tax, and then after tax is 128. So you are basically 128, okay, minus the depreciation. Then you are again adding the depreciation back in order to calculate your net operating cash flow. And last is the terminal cash flow or the ending cash flow. Terminal cash flow includes salvage value and also working capital. So the salvage value of this project is, remember, the 10% of the depreciation that has not been covered. So this 10% of 470 million is 47 million. This will be paid by the Malaysian government when they purchase your project. And then we have 30 million of working capital. This working capital will be paid back. 30 million of the working capital is coming here. So altogether is 77 million. Okay, now I have forgotten one thing to clarify. Let me clarify this now. Just be careful. Let me take you to the previous example. In the previous example, I told you that I will clarify this, but I forgot. So where is it? If you remember in the previous example, is this the previous? No, this is the, sorry, this is the previous example. In the previous example, Wolverine case, remember this here is this. The working capital will not be liquidated, right? Remember this point? So working capital will not be liquidated, meaning that this working capital will not come back to the company because the working capital is actually financed by the bank. So the company will not see the working capital coming back to the company. That's why in Wolverine case, you see with the initial investment at the end and with the salvage value 52 million, there is no working capital coming back. Okay, but in this case, in the current case, this sentence is not written, meaning that the working capital, whatever it is, let me see. The working capital is 30 million and it's not written that working capital is not liquidated, meaning that the working capital in this case is liquidated, meaning that the working capital will come back to the parent company. And this working capital is provided by the parent company, so it will come back. So what we are doing here, this salvage value in the terminal cash flow, ending cash flow, salvage value plus the working capital, and this together is 77 million. This 77 million will be added to the 305.784, which is 382.784 million in the last year. Altogether, we have these cash flows. You can see the cash flow to the subsidiary, 500 million in the 0 year negative value, and the rest of the figures are positive value. Okay, now the option 1 is when you are remitting your cash flow every year back to your parent company, but at a different rate. First year is 30%. The remaining figure you will invest. You see the arrow here, arrow is showing that you are investing the remaining figure. Second year you can invest 50%, 50% you have to remit. So after remitting the 50% you are investing. In the third year, 201404, you are remitting 70%, the remaining figure 30% you are reinvesting. And the fourth year, the entire figure 382784, this entire figure 100% you can transfer. With this policy, okay, I need to check why still the case is showing that there is a withholding tax on the remitted fund, because if this is the procedure, you don't need to pay any withholding tax. So I'm not sure whether they have, they have given only one case. So in one case, they should not include this withholding tax of 10%, because these amounts are basically the amount that you are reinvesting. So, oh, okay, it's clear now. So they, instead of this 220 million total, the company is only considering 66.6 million. So this is only the amount that is reinvested. So on the amount that has been reinvested, or the amount that can be sent back to the parent company, that is the amount considered for withholding tax, not the entire 220 million. So, okay, you understand, I guess. 220 million is the cash flow in the first year. Only 66.6 million, remember 30% of 220 million in the first year can be considered for transfer. The remaining 70% can be reinvested. So that is the figure that they are considering only. So on that figure, they are calculating 10% of withholding tax. I will check the Excel file again. I have the Excel file for the case solution. I'll see whether there is any mistake here or not. After the withholding tax, they have remitted funds. After the withholding tax, 59,940, 132,570, 181,263, and 759.217. After that, exchange rate considered calculation. Now exchange rate we need to calculate 0 year, year 1, year 2, year 3, and year 4. We'll be calculating based on inflation rate. So inflation rate in the US is same 2,222, and inflation rate in Malaysia is 3,455. And we need to calculate the EF percentage. If you remember, EF percentage is the difference between these two, inflation home divided by inflation foreign minus 1. So in the first year, it's a negative value. In the second year, it's a negative value again. Third year is a negative value. Fourth year also negative. So every year, Malaysian ringgit will be depreciated because their inflation rate is high. So from 3 ringgit, which is the current rate, Malaysian ringgit will depreciate, meaning that you need more Malaysian ringgit to buy US dollars. So it's 3.03, then 3.09, 3.18, and 3.27. These are the 4 figures we need to consider for our calculation. Now you see these figures are taken here. Let me take you through this. Exchange rate 3 in the 0 year, 3.03 first, 3.09 second, 3.18 third, and 3.27 4. Okay, after the exchange rate, now cash flow to the parent, just multiply with the exchange rate, you will get the figure. So 19.78 in the first, 42.939, 57, and 232. Required rate of return for this project need to be calculated. Required rate of return, remember cost of capital need to be calculated. How do you calculate this? Your risk-free rate of return is 5%. Return of the market is 17%. So we use CAPM. CAPM is risk-free rate 5%. Let me maximize it a bit. Risk-free rate 5% plus K minus risk-free rate 17 minus 5% multiplied by beta is 1.25. So 20% is the cost of capital. And this is for the mother company. But for Malaysia, you need to consider 2% extra. So 20% plus 2% is 22% for Malaysian cost of capital. So when you are calculating for the parent, this is net present value for the parent. You will use 20%, 20, 20, 20, 20, and 20. When you go to Malaysian case, you see 22, 22, 22, 22, and 22. So at 20% cost of capital, your present values are calculated, which gives you net present value of 24.768, which is a positive value. It means you can accept the project. And cash flow to the parent company, cash flow to the subsidiary company is calculated based on 22% of cost of capital, which is based on the original Malaysian ringgit. You see 500 million is 500 million, 222 is a 220, it's the original figure. This is the figure that you can transfer 100% back to the company. But you are not transferring anything because this is the subsidiary figure, right? You are not transferring anything to the parent. This is for the net present value for the subsidiary. So 22% cost of capital for each, cash flow divided by 1 plus k to the power t. T is 0, t is 1, 2, 3, 4. The net present value is 211,135,611. So this is also positive figure for subsidiary, and we will accept the project. So the conclusion is both from the parent company and the subsidiary value, this project is acceptable because the net present value is positive. Let me check any other information available from now. These are the two examples given, I think. Oh no, another one is given on coconut incorporation. Let me check, is there any other? No. Okay, let's do coconut, the capital budgeting one. Then we will move to the break and come back for the transaction exposure. Capital budgeting decision of Coconut Incorporation. It's also a US company, possibly investing in another country like Malaysia again. So the company wants to, this company sell mobile phones. This company is, I think it's a made up name. Instead of Apple Incorporation, they put Coconut Incorporation. Okay, the company wants to utilize its unique production process and planning to invest RM 110 million in purchasing and installing machineries. So the entire plan cost is 110 million. The project is expected to operate over the next 4 years. Time is given, 2016 to 2019. Coconut Incorporation has estimated the additional working capital required for this company is to be 10 million working capital. This is additional, remember very careful, this is additional working capital. It's not inclusive of the 110. 110 is only purchasing and installing machineries. It's not inclusive of the working capital. It has managed to sign a memorandum of understanding with the Malaysian government. Under the MOU signed, Coconut Incorporation will pay corporate tax rate in Malaysia at 25% rate. It can repatriate 100% of the annual subsidiary income to the parent company in the US, but only 10% withholding tax. Okay, government of Malaysia will purchase the project at the market value at the end of the operation, which is estimated to be 10% higher than the remaining book value. So calculate the book value first, and then increase the market value by 10%. That is the value at which Malaysian government will purchase the project from you. Government of Malaysia will not charge any tax on the proceed from the sale of the machineries at the end of the operation. On salvage value, there is no tax. Both the parties also have agreed on the terms that machineries will be depreciated following a modified accelerated cost recovery system, MACOS. The rate for MACOS is given below. So rate of depreciation is 20% first year, 30% second year, 22% third year, and 18% fourth year. Exactly the same rate just we have discussed in the previous example. Table 2 shows information on demand, price, and inflation rates pertinent to the project. Coconut Incorporation is planning to adjust only the variable cost for changes in inflation rate in Malaysia. So there is a change in variable cost due to inflation rate. Price per phone is estimated to be fixed over the next 4 years due to higher competitive risk. So they don't want to lose the market, so they will keep the price per phone is same. They will subsidize it most probably. The demands are already adjusted for the inflation rate in Malaysia, so demand figures are already adjusted. The supplier of raw materials has agreed that they will reduce the variable cost by 5% on the total variable cost. On the total variable cost, if the demand exceeds 200,000 units. You see, there are more tweakings coming. So the supplier agreed that the variable cost that they are supposed to charge, they will reduce it by 5% if the gross figure for demand unit increases or goes above 200,000 units. So if you are selling more than 200,000 units, the variable cost will drop by 5%. Variable cost for the first year is given in table 2, and the remaining variable costs are to be estimated based on inflation rate and the discount. Okay. So in the table, look at the table information for sales and price estimate for each year. For year 1, 2, 3, 4, the price for product is same, 1500. It's a very expensive phone. Anyway, for Bruneian, it's cheap, it's $500. But it's a hypothetical example, it's a hypothetical case, so don't worry about it. The demand figures in the first year is 140,000 units, second year 225, 300 and 400 in the third and fourth year. Meaning that you will get the discount from the second year. Supplier will give you 5% discount on the variable cost. Inflation rate in the US is given 2, all year same. Inflation rate in Malaysia is 2, 3, 4, 5. It's increasing, so Malaysian ringgit appreciated over time. The variable cost per tablet. Oh, it's a phone. You see, it's a wrong thing. Variable cost per phone is first year is same. There is no discount, so it's 750 ringgit. Second year, third year, fourth year need to be calculated based on inflation rate, based on Malaysian inflation rate. So in the second year, 3% increase. In the third year, 4% increase. In the fifth year, 5% increase because of inflation rate. And then you get 5% discount because of number of units. Remember, number of units, 200,000 units or more, the supplier will give you 5% discount, right? So you'll get 5% discount for year 2, 3, and 4. But at the same time, you need to increase the variable cost by 3%, 4%, and 5%. Annual fixed leasing expense for the office space in Kuala Lumpur estimated to be RM 20 million. My goodness, what a big office they are renting. To avail the lease, Coconut Incorporation, so this is a 220 million ringgit leasing expense. To avail the lease, Coconut Incorporation has to keep aside Malaysian ringgit 1 million as safety deposit in CIMB Bank for 4 years. So this is the amount they have to keep as safety deposit in order to get the fixed leasing for 20 million for the next 4 years. But this fixed deposit, what they are keeping in CIMB Bank, will earn at 8% rate. It's not free, so they will give you some return, 8% from the first year until the last. This amount can be withdrawn at the end of operation after 4 years with interest. So you can withdraw this amount at the end. Salaries and admin expenses are estimated to be Malaysian ringgit 10 million in 2016 and need to be adjusted for inflation rate each year until 2019. So inflation rate in Malaysia, 2%, 3%, 4%, and 5% need to be adjusted. Branding expenses are estimated to be Malaysian ringgit 15 million annually. Okay, so there are a lot of expenses. Assume that today is December 31st, 2015. The spot exchange rate is USD to Malaysian ringgit is Malaysian ringgit 4.50. Company does not have to pay any tax in the United States on subsidiary income. There is a tax credit given. The corporate tax rate in the United States is 30%. The company at present is heavily equity financed with only 10% of debt. No more problems coming up, more tweaking. So they are giving you now percentage of equity and debt. Percentage of equity is 90%, debt is only 10%. So it's heavily equity dependent. The capital structure is expected to be the same for the new subsidiary. So for the new subsidiary in Malaysia also, it will be 90% equity, 10% debt. The pre-tax cost of debt is 15%. Pre-tax cost of debt is 15%. Beta of the parent company is 1.7, while the market return and risk-free rate in the United States are 10% and 1% respectively. The required rate of return is the same for the subsidiary and the parent, no risk premium to be added, and estimated to stay constant over time. So you'll calculate for the parent company and same will go for the subsidiary. What is required? Prepare a report for Coconut Incorporation. You should analyze the financial prospect for the subsidiary as well as for the parents. So for both cases, you'll calculate NPV and make a decision. Let's go with the solution and see how it does, how it's been done. First, we identify the time. You see again 0, 1, 2, 3, 4. So you can follow this format. It's easy. So the basic machinery is 110 million. Working capital is 10 million. And one-time fixed deposit. Remember, you have to keep one-time fixed deposit is 1 million. This is for the rental. So the initial investment is 121 million. Okay, in Malaysia. Now the next information will be operating cash flow. Start with demand. Demand is 140,000 unit, and the demand figures are already adjusted for. Price per unit is also fixed 1500. Total revenue, variable cost is 750 in the first year, right? Second year, third year, fourth year will change. Total variable cost is given. Net variable cost, discount adjusted. Now in the first year you see 105 variable cost, but the number of unit is 140 unit. It's below 200,000, so no discount. If no discount, 105 same. But in the second year you see 173 is the variable cost, but 165 is the net variable cost after discount. In the third year you see 241 is the variable cost, but 228 is the net variable cost after discount. In the fourth year, you have 337, but the net variable cost is 320 because of the discount. The discount is 5% by the supplier on the variable cost, the total variable cost, because the number of units sold is more than 200,000 units. Annual leasing expense, 20 million. Salaries expense, 10 million. Branding expense, 15 million. Non-cash expense depreciation based on the rates. Remember the MACAS depreciation rate. What are the rates here? The rates are given here 20, 30, 22, 18, right? And this will be calculated based on basic cost. Basic cost of the machine is, let me show you in the initial investment. Basic cost is 110 million. So first year 20%. Let me check. 110 million, right? 110 million multiplied by 20%. Non-cash expense depreciation first year 22 million. So it's 20%. Then you consider the other figures for the rest of the calculation. Now, if you want to calculate the book value of this machine, that would be 20% plus 30 plus 22 plus 18, so 90% covered. It's a 4-year machine class, so 90% covered. Remaining 10% would be the book value. On this 10%, you will add another 10% to calculate the market value according to the information given, right? So let's go back and see how these are calculated. We'll come back to this later on. Total expenses calculated before tax earnings of the subsidiary, and then you give host government tax in Malaysia 25% according to the agreement with Malaysian government, and then after tax subsidiary income is 28.5. Net operating cash flow is 28 plus the depreciation. Depreciation is 22. So 28 plus 22, 28, 5 plus 22 is 55. 50.5 million. And the rest of the figures will be automatically calculated. Okay, just one thing here is when you are calculating variable cost, this has to be adjusted for inflation rate. So 750 next year adjusted, increasing by inflation rate in Malaysia. Third year increasing by inflation rate in Malaysia. Fourth year increasing by inflation rate in Malaysia. Year by year increase because of inflation rate. Okay, now come to the terminal cash flow. The terminal cash flow is, first is the salvage value, 10% higher than the remaining book value, right? So Malaysian government will purchase the project from you 10% higher than the book value. Our book value is 10% already. So our machine cost is 110. Book value is 11 because the 10% of it. And from that 11, you increase by another 10%, which is 12.1. So 12.1 million is the cost of our is the return for our salvage value. Working capital will be liquidated. It will come back 10 million. And withdrawal of the one-time fixed deposit with interest. Remember, 1 million we have invested for 4 years, and after interest, this figure is 1.360 million. Altogether, the terminal cash flow is 23,460 million. Okay, these are the net cash flow. This is from 0 year coming down, 1 year, second year, third year, and the fourth year. In the fourth year, we have two values. One is 179, the other one is 23.46. Altogether is 203.307. Now, analysis from the subsidiary perspective first, we need to consider the required rate of return for the subsidiary. Need to calculate the required rate of return. This is calculated here, cost of capital or required rate of return for the parent. Parent and subsidiary is same figure. Debt is 10%, equity is 90%. The cost of debt is 10.5 and cost of equity is calculated 16.3. How this 16.3 is calculated? Let me show you the information. This is calculated based on CAPM, the same stock information, stock beta information. Let me show you. The market return is 10%, so 10 minus 1% is 9%. 9 multiplied by, let me show it here. So basically this is 10% minus 1%, and then we are multiplying with the stock beta, which is 1.7. So altogether it becomes 15.3, and the 15.3 will be added to the risk-free rate of return, should be 16.3. Let's check any other thing here or not. Pre-tax cost of debt is 15%. Okay, there's nothing else. There's nothing else. So let's go back to the calculation. Where is it? Okay, so you see 16.3 is written here. Calculated cost of capital is 16.3. Okay. Now the first one, debt, cost of debt. How do we get this 10.5%? How do we get the 10.5% calculation for cost of debt? Cost of debt 10.5% is calculated based on, you see here it is written, the pre-tax cost of debt, pre-tax, before tax, cost of debt for the parent company is 15%. So we need to calculate after-tax cost of debt. After-tax cost of debt is 15% minus the tax rate. So the tax rate for the parent company is 30%, right? Tax rate for the parent company is 30%. It's written here. Okay, so you will just take 70% of 15%. 70% after deducting 30%, you need to consider 15% multiplied by 70% of it is 10.5%. You can see that already, 10.5%. So let us see whether it is 10.5%. Exactly, it is 10.5%. So weighted average cost of capital, weight of debt is 10%, cost of capital is 10.5%. Weight for equity is 0.9 and cost of equity is 16.3. And we have calculated weighted average cost of capital by multiplying each of these. 10% multiplied by 10.5 is 1.05. And 90% of 16.3 is 14.67. So altogether, this is 15.73 cost of capital for the parent. 15.72. So we now put this figure here. Required rate of return, cost of capital is 0.1572, means 15.72%. And this will be repeated for all the years. I have only shown in 1 year. They have only shown in 1 year, 0 year. And the rest of the year, it will be same cost of capital. And they have calculated the present value is cash flow divided by 1 plus k to the power t, which makes it, the net present value makes it 202.105.894. This is a positive figure, even though it's red color, it's still a positive, it is still a positive figure. Next one is the analysis from the parent perspective. So you need to now transfer your income back to the parent company and see the 100% income to be remitted to the parent company. So it's coming from the 50.5, 103.558. This is 103.558, 137.539, 137.555, 539. So you understand where the figure is coming from. Withholding tax to be paid 10%, so we pay withholding tax 10% deducted. So next is exchange rate. Exchange rate is to be calculated. So we go to the exchange rate calculation part. You see calculation of exchange rate. 0 year it was 4.50, and in the first year the inflation rate for the US company, which is the home for your company, is 2% all. But for Malaysian operation, foreign company is 2%, 3, 4, and 5%. So in the first year, EF percentage change is 0. Inflation rate difference is 0. So the exchange rate will be same, 4.5. In the second year, percentage change is 1% almost. Third year is almost 2%. In the fourth year is almost 3% change. You see 2.86% change. In every year, Malaysian inflation rate is increasing, so Malaysian currency will be depreciated. So from 4.5 in the next year, Malaysian ringgit is 4.54, meaning that you need additional Malaysian ringgit to purchase US dollar. Third year is 4.63, and the fourth year is 4.76. So we'll consider this figure here. You can see the figures are plotted here: 4.5, 4.54, 4.63, and 4.76. After calculating, adjusting for the exchange rate, you can see the figures are given here in US dollar. This is 26, 888, 11222, 22791, 29699, and 42681. The next thing is similar to our subsidiary is considering the required rate of return 15.72% and calculate the present value. After calculating present value, cash flow divided by 1 plus k to the power 0, 1, 2, 3, and 4. We have the present value is 42,795,864 in US dollar. First one is in Malaysian ringgit, the second one in US dollar. So in general, looking at the figures, we will accept the project since both the perspective offer us the positive cash flow. Let us read the explanation given. The decision criteria based on NPV, the company may accept the project from subsidiary as well as parent perspective, because in both cases the NPV is positive. Increase in variable cost. What are the other factors that you need to consider? Increase in variable cost will increase economic exposure primarily for the subsidiary and the parent in the long run. In order to reduce economic exposure, which will reduce the NPV of the project, managers may think of diversifying the sourcing of raw materials, importing from Taiwan, for example. The company may also look into restructuring internal cost structure in order to make the company healthy in terms of handling sudden change in the variable cost in international market. Last option would be using hedging to safeguard against the higher payment for the import of raw materials, if any. The company may use swap contracts to or back-to-back credit to reduce the foreign currency exposure. So there are different options discussed depending on the scenario that you are handling. You will consider what should be safe for this company to in order to make the cash flows in the future more certain. So for now, since these are positive cash flows and positive cash flows by a good margin, very good margin, 42 million USD and 202 million Malaysian ringgit. So it's a good margin in terms of the figure. So we will accept this project. We may accept this project depending on the figures given, and the company may proceed with the project, investing for the next 4 years in mobile market in Malaysia. Okay, we'll stop for a while and we'll come back with more examples on the transaction exposure. We'll come back with transaction exposure. We may not do all, but we'll try to see at least 1 or 2 to give you an example. Apparently, transaction exposure example is relatively easier and short, brief compared to the capital budgeting. Capital budgeting one is easy. Capital budgeting is easy but long. Transaction exposure is a bit tricky but short. So you need to make a decision which one you want to do in the test, because you need to finish within time, and don't miss the chance. This is your last chance, to increase your mark and before the assignment submission. So try your best. So we'll take a break now. Let's say 20 minutes. We'll come back after 20 minutes, around, let's say, 10:10 or 10:15. Let's say until 10:15, we take 10:15. We'll start again with the transaction exposure. Okay, welcome back everyone. Let's continue with our examples on the transaction exposure. First one is Carbondale Incorporation. And it's a US based company. And let me give you a brief on the transaction exposure again. This is a risk for export and import operation for which a company is expecting that their receivable from export might be lower and their payables might be higher. So they want to reduce their payable and they want to increase their receivable. So they come to the hedging market. They buy hedging instruments in order to protect their receivables and payables. So that is called transaction exposure. This is from usual transaction like payables and receivables from import and export. Let's take the first example. We have taken already an example in the previous class, in the original class. So let's take this example first. Carbondale Incorporation is a US-based company that expects to receive Singapore dollar 500,000 in 1 year time. The existing spot rate of the Singapore dollar is 0.60 $0.60 by 1 Singapore dollar. The 1 year period, 1 year forward rate for the Singapore dollar is 0.62 for 1 Singapore dollar. Carbondale created a probability distribution for the future spot rate. So in the future, the spot rate for dollar to Singapore dollar is 0.61, 0.63, 0.67, and the probability is given for each of these. 20% probability that it would be 0.61 and 30% probability that it would be 0.67. Assume that 1 year put option, because it's a receivable, right? So it's a put option, receivable for put option. 1 year put option on Singapore dollar are available with an exercise price of 0.63. I think you know what is an exercise price. This is the price at which you decide whether you are using the contract or not. And there's a premium cost for the put option, 0.04 per unit. 1 year call option on Singapore dollar are available with an exercise price of 0.60 and a premium of 0.03 per unit. Call option is for payable, put option is for receivable. Assume the following money market rate. If you want to do money market hedging, the money market rates are given. Deposit rate in the US and Singapore, 8 and 5%. Borrowing rate in the US and Singapore, 9 and 6% respectively. The questions are, given the information, determine whether a forward hedge, money market hedge, currency option hedge would be most appropriate. Then compare the most appropriate hedge with an unhedged strategy. Decide whether Carbondale should hedge its receivable position or not. So this is for receivable. Assume that Baton Rouge Incorporation USA is a USA-based company, and this is another party, another example. Baton Rouge Incorporation is a US-based company. The company expects to need Singapore dollar 1 million in 1 year. They will require this using any relevant information in part A. So the previous this information that is given of this question, determine whether forward hedge, money market hedge, or a currency option hedge would be most appropriate. Then compare the most appropriate hedge to an unhedged strategy and decide whether Baton Rouge would hedge its payable position. So there is a receivable example for Carbondale, and there is a payable example for Baton Rouge. So we need to do each of these step by step. Let's do receivable first. Okay, now the forward hedge information given. Let us see the forward exchange rate is 0.62, right? Forward hedge is 0.62. So the forward hedge information is given. We are selling Singapore dollar, right? When we receive, we are the US company. Carbondale is a US company. So you will sell Singapore dollar when you receive it, multiplied by 0.62 is $310. So your exposure is $310 maximum. Money market hedge. This is receivable. For receivable, the steps are borrow, convert, invest. You should know from the PowerPoint slide. Remember the PowerPoint slide that we have done in the class. For receivable, this is borrow, convert, invest. So borrow Singapore dollar, then convert to US dollar and invest in US dollar at the US dollar rate. So altogether at the end, 305,660 is the exposure. Put option for receivable, call option is for payable. So put option hedge, exercise price 0.63 and premium of 0.04. The possible spot rate 0.616367. Option premium 0.04 each. Now you need to decide whether you exercise or not. In receivable, in case of receivable, you will deduct it. So 0.61 minus 0.04. Okay, and you also have an exercise price. Exercise price is 0.63. So 0.63 minus 0.04. So let me write it here. The fixed benefit from the contract. Fixed benefit from the contract, let me write it, is 0.63 minus 0.04. Okay, so this will be 0.59, right? This is the net benefit. In receivable, we have to deduct the premium because in receivable, you'll receive 0.63 and you'll pay a 0.04. So if 0.63 you receive and pay 0.04, it's 0.59. Okay, so this is the net you receive. And you need to compare this with the individual spot rate. So individual spot rate is 0.61 minus 0.64, 0.04. So you have basically 0.59, right? So 0.57 compared to 0.59. So you will receive more in contract and you will receive less in spot. So do you exercise the contract? Yes, we'll exercise the contract. How much you receive if you exercise the contract? 0.59 you receive coming from here. What is the total receivable? Just multiply with the figure and you get 295,000. Probability is 20%. Second one, 0.63, 0.04, exactly similar to our exercise price. So your decision is either you can accept or no. You know, my suggestion is we accept because contract is fixed, spot rate is not fixed. So contract is more secure. So we'll exercise the contract. Amount is 0.59 multiply. 0.59 is fixed because it is the contract, and 295 is a fixed figure at 50%. Last one, 0.67 is the spot, minus 0.04 is 0.63, whereas the contract is 0.59. So we'll not exercise the contract because we'll get from the spot market much more. So we will not exercise. Amount received will be 0.63, 0.67 minus 0.04, 0.63 multiplied by 300, multiplied by the receivable amount. I think 50,000. So 500,000. This is $315,000 US dollar at 30% probability. So you can give an explanation that which one is more probable, what is the amount that you are going to receive. So there's a 70% chance that your receivable will be 295, whereas your money market hedge is 305 and your forward hedge is 310. So forward hedge is the highest, 310. So we can go for forward hedge if we are conservative company. If we are aggressive company, you may go for a spot rate, which is 315. There's a 30% probability that 315 is going to be the receivable. So depending on what type of company, if you remember in the previous class, we said that there is a possibility that you may increase your receivable based on if you are taking extra amount of risk. In the unhedged strategy that you are not hedging, you're going with the spot rate 616367 multiply with the 500,000 Singapore dollar. You'll get 305, 315, and 335. And there is probability of 20%, 50%, and 30%. So there is at least 70%, 20 plus 50, 70% probability that your receivable will be 315, which is higher than any other option before. And there is a 30% chance that your receivable can be even higher to 335. It means that if you are an aggressive company, you can make a lot more receivables by taking risk in the spot market rather than going with the contract. Okay, so you may now decide whether you want to hedge or you want to stay with the unhedged strategy. So depending on your risk appetite, depending on what kind of company you are risk taker, you are conservative, you will choose your specific strategy. Let's look into Button Rouge. They have 1 million Singapore dollar as payable. They need to pay. So in order to pay, they need to purchase Singapore dollar. They need to purchase Singapore dollar. The forward rate is 0.62. So forward hedge will tell you 620,000 US dollar needed in order to pay for $1 million of Singapore dollar. Money market hedge. Okay, it's opposite to receivable. In payable, money market hedge is invest, borrow, invest, convert, and borrow. Invest, convert, and borrow. So it's opposite. If you can, if you go to the receivable is borrow, convert, and invest. And in payable case, it's invest, convert, and borrow. So they found that the total money market hedge amount is 622.857 in forward contract, which is 620. So obviously forward contract is less expensive. And then comes the call option. Call option is the right to buy. So you need to buy foreign currency, Singapore dollar, to pay for your payables. So call option fits with payable. The exercise price is 0.60 and the premium is 0.03. In this case, you need to add both because both are payments. 0.60 is the payment, 0.03 is the payment. So together is 0.63. Let me write it for you so that we can refer to this. So the total payable, total payable would be 0.60 plus 0.03, right? So it should be that $0.63. So this is the total payment for the payable contract. So you can actually compare when you're making the decision. You can actually drag it here. You can compare this here. So first one, in the possible exchange rate in the market, 6.1 and 0.3. So this should be 6.4. Okay, you can buy in the market with 6.4. You can go with the contract at 6.3. So you will exercise the contract. And the amount that you pay is 6.3 multiplied by the foreign currency 1 million, you get 630,000. Second one, 6.3 plus 3, it's even higher. So you still will go with the contract. 6.7 plus 3, still you'll go with the contract. So in all cases, you will exercise the contract because contract is less expensive to buy to buy foreign currency. And all the cases your exposure is same, 630,000. So 630,000 call option is much higher than forward hedge and much higher than money market hedge. So no way you can go with the call option. Unhedged strategy is that you go with the spot market 0.61, 6.3, and 6.7, and the cost goes up from 6.10 until 6.70. But there's a 20% probability that you can reduce your cost to 6.10, whereas 50 plus 30, 80% probability that your cost would be 630 and above. So obviously in this case, we will hedge, and we will hedge with forward hedge. Forward hedge is 620,000. If your company is even aggressive, I don't think so that they will go with 6.1 in the spot market in order to reduce the payable to 6.10, because the difference between 6.10 and 6.20 in forward market is only $10,000. In order to take a risk of reducing this $10,000 payable, the company may lose a lot of money. So this is not a risk worth taking. So my suggestion is that secure payment is 620,000 with forward market, and company should go for it. So depending on your risk appetite, risk practices, you will consider which hedging strategy you should take. The other example on hedging will be more or less similar. You know, hedging examples are basically similar examples. There cannot be, you know, many more tweakings, except that there might be, instead of 1 year, there might be 180 days. You know. So let's read the decimal incorporation. Similar examples, just maybe changing the time frame. Instead of 1 year, it is 180 days. The rest of the figures are all same. You will have money market information, deposit and borrowing rates. You will have option market information, call option and put option for receivable, call option for payables. You will have forward market rate, spot market rate. You know, all information will be same, and you need to do a similar practice, that you need to check whether they should hedge. If they hedge, with what contract they will be hedging. If they are not hedging, then possibly they will remain unhedged. You need to explain why you are not hedging. So difference of time frame. Okay, the only problem is you need to follow the step in money market hedge. For payables and receivable, there are different steps. You need to follow that. And for call option and put option also, you need to follow carefully. Call option is for payable, and for payable, you need to add strike price and the premium. For put option, you need to follow the receivable, and for receivable, you need to deduct the premium from the strike price. If you remember this few small thing, you know, the calculation is very short, calculation is very quick in transaction exposure. Many students in the past, I have seen that they have chosen transaction exposure rather than capital budgeting, because capital budgeting is easy, but it's very long sometimes. Solutions are given for you. Just look at it later on whenever you have time. The last one is transaction exposure for coconut incorporation. See whether there is anything here that we need to look into. Let's read it. Coconut Incorporation is a mobile producer, exporter based in the US. It has operation in Japan, Germany, and Malaysia. Okay, now they are considering 3 operations. The company also imports raw materials from Germany and pays in euro. I think this is a similar example we have done already. The CFO of Coconut Incorporation has decided to hedge the receivables and payables, has contracted your company to produce a summary report on whether to hedge or not. The amount to be borrowed, amount to be received from Japan is 250 million Japanese yen in 360 days. So it's a 1-year contract. Total amount to be paid for the import is euro 116,000. So this is the example, exactly the example that we have done in our class. So what you have to do is, there are spot rate given. There are the future spot rate given in 360 days. Scenario 1, scenario 2, and scenario 3, and there are probabilities given as well. There are forward rates given for the 2 currencies in the future, 1-year forward rate, and also borrowing rate and deposit rates are given for money market hedge. Finally, there are option market information, call option, exercise price and premium, put option, exercise price and premium given for the option market decision. So what you have to do is just use the information and repeat the same exercise. You'll do one for receivable, one for payable. You'll use the contract and remain unhedged decision, and finally come up with the conclusion whether the company should hedge. If they are hedging, what contract they should use. If they are not hedging, how they should go to the spot market. Okay, one final thing is that just make sure, don't forget it. This is a very basic thing. Sometimes students forget it. Basic thing is that for payables, we do we will definitely choose the lowest option, lowest cost, because for payable you'll pay, right? So you will choose the option that is the lowest costly option. And for the receivables, we will choose the one that is the highest, because company wants to receive the highest receivable, right? So highest receivable and lowest payable. That's it. If you remember these two, this should be okay. Okay, so our practice part is over. I have already uploaded this for you in the canvas. Let me show it to you. Okay, if you go to your course in strategic financial management, at the very last of these topics, you see review of topic 9 and 10. So these are already being uploaded. And there are additional uploading also on transaction exposure. I've given example of Maxima Incorporation, and also which is similar to the Coconut Incorporation, almost similar, and capital budgeting for Vita Dell Incorporation. So there are at least 3 today. We have done 3, 6 today, and 2 already given previously. So 8 examples done. I hope this is enough to cover for your online test. I'll try to make it as easy as possible, inshallah. I'll give you. Can we show our face at least for the last time, since this is our last day, and I have a small announcement to make. So everyone take 2-3 minutes, get ready. We'll try to open our video. We'll not take any photo, I promise you, but get ready first. We'll try to open our video by, let's say, 10:40. Okay, 10:39, 10:40. Take 2-3 minutes time, dress up properly. Okay, and we'll try to have a small discussion. Okay, everyone. If you are ready, then possibly I can. Okay, I think you can see me. You are not forced to. Um, you are not forced to open your video, but since I said that I want to share something, so and this is our final class, so possibly we can see each other for the last time. So is there anyone else? I can see only Noor Shukrina, right? Noor Shukrina, I only see your face, no one else. Anyway, okay, at least you can hear me. So is there anyone else waiting for us? No. No. Is there anybody else is really listening to me, or everybody went for Hua Ho to do shopping? So if you want, you can open your video. You can switch on your video so that we can see that you are still here or you have not left for Hua Ho shopping. Okay, nobody wants to come anyway. So we need to manage our time. So it's closing 11 almost. Okay, the reason is that so you almost I have given you all information whatever needed for the test and also for the assignments, and inshallah you will prepare good. I hope so. I have a good news to share. I'm sure it's a good news for everyone. The good news is it is official, but it's not public. The difference between official and public is that an information can be official. It is approved, but it's not for public use. It's still within certain limit. Okay, we see Muhammad Zamri with a barbell on his shoulder. I think in a sports chair. He's okay. That's a speaker or something. Do you do music, Zamri? No. You are muted. You can unmute yourself. You don't do music, but do you do gaming? I think you do gaming, right? Okay, great. Yeah, I do gaming as well. PS5. I want to sell my PS5 though. It's giving some disturbance. Anyway, so for the rest of you, so once again, the information is official, but it's not public yet. Is that I'm leaving Brunei very soon. So I have tendered my resignation a month ago. It's family reason, personal reason. So possibly this would be my last semester with you, and this would be your last semester with last year at least with UBD. So I wish you all the best, since you will be going into some form of career. And I had a lot of expectation this semester that I will try to at least force some change in UBD so that they do restructuring of the courses and other thing. And some of the topics that I've covered actually is still officially CNET approved, but I still covered it because many of you will never get this topic unless these are covered in some form. In any case, we took some risk together. We tried to introduce ourselves into completely different territory that was never available in Brunei. International finance is not a course taught in UTV. It is not a course taught in UNISA. So you are the only one who has some idea of hedging, some idea of derivatives, some idea of capital budgeting for cross country. So you have some idea of foreign exchange rate, some idea of using inflation rate to calculate foreign exchange rate and others. But in fact, international finance is a major area in outside. If you go to Malaysia, Singapore, I taught this course in Singapore. I taught the same course in Malaysia, in the UK as well. So they emphasize international finance to be a very important course. This is considered as a capstone course, meaning that 4th year. This is level 4 course, or in UK system they call it third year honors course. And therefore, it's very important course. If you are applying for international banks, cross-border financial analyst or other position for CFA, this would be very important knowledge for you. And I hope that you will continue this in the future. Possibly you will do a master's if you have time, MBA or something in the future, and try to choose international finance as one of the courses. You will have fun if the lecturer is good, and you will be in real trouble if the lecturer is bad like me. So the other course would be quantitative finance. We also don't do quantitative finance. We say quantitative analysis, but it's not quantitative finance. The portfolio management, optimization, and others using technology. I tried to do it, but we didn't. At the middle, our unfortunate thing is that our lockdown started, and the thing that I wanted to show you cannot be shown in without a lab. So unfortunate that this semester it did not happen. I had to change also the course content for the other course for modern financial theory that I teach at the master's level because of the lockdown, because we designed some of the content to be delivered in the lab, which eventually did not happen. So I hope that I have given this message already to UBD SBE so that they restructure these courses, because some of these courses were not restructured in the last 15-20 years since the beginning, I think. So we took some risk together in order to lead some changes, and possibly, the new lecturer, whoever is going to take over, is going to change the content depending on the suitability and other aspects. So I wish you all the best, and I hope that you will not be afraid of finance. Finance is a mathematical course. It's a logical course, and in order to understand finance, you need to understand the rest of the other courses. You need to have good understanding of marketing. You need to have good understanding of sales. You need to understand IT. You need to understand accounting. Okay, you need to understand financial markets. One of the unfortunate thing in Brunei is that we don't have a financial market. We only have bank market, which I do not consider as financial market. Bank is a separate market. It's not a securities market. So it's very limited opportunity for us to teach you finance in Brunei. It's quite risky as well. If you go outside and study in other countries where there is a stock market available, they will take you deeper into stock analysis or other financial market analysis, which is for us, as you can see, that every other classes I'm giving example from Malaysia, I'm giving example from Singapore. The reason I'm taking example from other cases because we don't have a stock market and we don't have a financial market. So hopefully, if Brunei introduces Brunei exchange in the future, that I hope that it's been rumored that it's been happening for quite some time, but didn't happen. So if in the future it happens, it will be some more opportunities for students like you to learn how stock market works, and there'll be more challenges for UBD student because you are the #1 university in the country. So stock market investment will be led by students of UBD. Stock market investment would be kind of like the brokers and dealers. Those will be working in stock market. In foreign exchange, the dealer, it's a very big position outside. Foreign exchange dealer earns easily $1 million per year. So in Brunei also, there will be increasing opportunities in trade and foreign exchange activities in the future, hopefully. So some of these activities will be done by students like you. So you need to train yourself on different courses in finance so that you can take up this position in the future. The last thing that I want to see is, you see, there are a lot of accountants. We have a lot of accountants doing SCCA maybe chartered accountantship. This is good. In a market where you do chartered accountantship, you get a good job, decent job. But in finance, you won't see many people doing CFA. In Brunei, I think there are, you can count them like 10 or 15 CFAs altogether, and they are all highly established in top level. The head of Baiduri, head of BIBD Securities, they are all CFAs, and their salary is really, really high. So the difference is the difference between a CA and a CFA. Both are reputed, degrees, certification, but CFA is much more rigorous and very tough. The first two level is easy. Level 1 and level 2 is easy, but level 3, which I also could not complete. I actually didn't have time to do it. You have to do it in a row. If you have a gap, you can never complete it. So I finished 2 rounds, two sets in a row, and then I gave some gap, and I never could complete it. So it was 8 years ago. If I want to sit for it, I have to re-register. So I don't have the energy actually, and now the questions are now really, really tough to do valuation in the class. So for example, the calculation that you have done for, let's say, 1 hour, 1.5 hours in CFA exam, the same calculation you'll be given, for example, 10 minutes to do. So you have to have real expertise in calculation, valuation in order to sit for CFA. But I'm not going to create a lot of fear for you, because CFAs are done by people like us. So try for it, go for it, see, even if you fail, still you can say that you are CFLO level 2 certified or level 1 certified. This would be a good opportunity for your company as well. It will increase your employment opportunity and altogether your professional qualification. So you need to decide now. You need to decide whether you want to go for accounting profession or you want to go for finance profession. If you go for finance profession, try to do certification in finance. There are other certification as well. For example, you will have certification for financial risk management. If you do financial risk management, you can work in bank as well, insurance companies as well. There is a entirely new area. It's not new area. It's very old, but it's not even yet introduced in Brunei. There is a course available in UTB. I tried to introduce in UBD, but UBD was not interested. It's called Actuarial Science. If you do Actuarial Science, you will be a boss of valuation. You can do stock valuation, insurance valuation, leasing valuation. There are huge demand for actuarial students in finance in different countries. So if you do a master's on Actuarial Science, I'm sure when you come back to Brunei, you'll be taken instantly by insurance companies. So with a very good salary. The problem with Actuarial Science is it's all math and statistics. So if you're not good at math, don't go for Actuarial Science. It will give you a lot of trouble. CFA is a mix. You have qualitative knowledge and also quantitative mathematics, statistics knowledge. So decide your career carefully so that you can take minimal effort and can learn maximum. Because in Brunei, most of you local students are not, I believe that you are not paying much. There are social costs, but obviously tuition fee is not there. But foreign student you are paying, so the education should be worthy, should be financially worthy. When you go outside, local and foreigner both, you have to pay, and that must be cost worthy, time worthy. So make a decision, don't make a wrong decision. Make a decision carefully. Finance is still growing in Brunei, and it will grow. It will continue to grow. The last message of all is add technology. Whatever you do in finance, the future in finance is mostly based on informatics, based on analytics. So I wanted really, really hard to at least give you an introduction to fintech this semester using either R or Python, but it did not happen. One of my students, I can see her here, Noor Amira. Amira was working previously with Amira. What's the company? I forgot. Can you unmute yourself? You click twice.
Oh, sorry, it was dynamic technologies.
But yeah, dynamic technology. But what's the software you are using? Microsoft Power BI, right?
Yeah, Power BI.
Okay, so Power BI can be an alternative as well to Python and others, but Power BI is, in my opinion, is still less developed. But it's more user friendly. It's connected to Microsoft Excel. So if you want to spend some time in the future with finance, also learn some technology, learn some analytics. It will help you a lot. It will make your job easier. It will make your life easier because technology with finance is easy to manage. If you have finance without technology, it's very difficult to manage. So in the future, try to combine technology with any professional degree you are doing. Technology is here to stay, and it's going to reduce a lot of job pressure. So try to learn it. It's a good thing. That's all from my side. So I'm planning to. I'm not yet sure because my approval yet not come. So I'm still waiting for the final approval from the Prime Minister's office, possibly, or from the university. So hopefully we are hoping that we may want to leave sometime in the end of December or the first week of January or within the first half of January. So we are primarily going to UK, and then we'll decide where to go. But our family members are not well, so that's the decision that I had to take. And obviously, career issues are there as well. I want to add up. I want to grow. So I'm getting older. So this is possibly my time to grow. Uh, Brunei obviously is a nice country, is a beautiful country, but institutionally still there are barriers to growth. So I'm not saying that people are bad. It's the experience that we need to have, and then reflect on that experience to create more opportunities. So I believe that for me, opportunities is still the way I'm going. I'm going at a much faster rate than the rest of my colleagues combined, for example. So it's kind of like I don't want to be in a place to create, problem for other colleagues. So I want to find my own place, and I do other things that are often very difficult for Brunei to manage. So I do foreign exchange trading and other things. And foreign exchange market in Brunei is basically bank based, so very limited opportunity. And yeah, and personal reason, my family members are actually not well, so I ask for your prayer as well, and I'll pray for you as well. You're my last batch of UG. I still have connection with my first batch. I still receive their WhatsApp messages. They are working in different organizations, and some of them still do video chatting with me. That's all. So if you want to say anything, we'll take only 5 minutes for that. If you want to say anything, if not, then I will close it and I will wait for your questions. If there is any question regarding the class test, and your submission time is 30th November. The assignment submission, it's already open, you can submit, but the final submission is 30th November. Hopefully within 2-3 days, you will get all the results. So by the first few days in December, you'll get all the results. And don't be surprised when you see the final result, because I don't have hands on your final result. That some hidden hand decided in the faculty. It's a committee that decides the final grade based on the grading schedule. So I won't be able to also share with you the result of the final test. Okay, I won't be able to share the result because this is kind of like restricted or cannot be shared. So that's a problem. That's a problem somewhere. But I'll try to be as soft as possible so that I can bring some good memories back home. Yeah. Any question you have? 5 minutes only. You can unmute yourself and question. Otherwise, we'll leave.
Hi, sir. I don't have a question, but I just wanted to say thank you for all the knowledge and advice you've given us. Because I personally, you've given me a lot to think about in terms of my next steps after I graduate that I wouldn't have thought of before. So yes, thank you for that, and all the best with you and your family. And I pray for healing for your family members who are not well. So thank you.
Oh, thank you. Rita, are you the one working for KPMG or one of the firms? Did you do any internship there?
Hi, sir. Sorry, I didn't quite hear you.
Did you do an internship in any one of the accounting firms?
Oh, yes, I did intern at Ernst & Young, and then afterwards I was interning at United Overseas Bank. So I preferred my experience at the bank because I was working in the compliance department. So then I learned a lot about Excel and also could interact with the finance department. So I was very interested in finance, and now I'm thinking maybe I will go that route, or I don't know. I'm still thinking, but I have a lot to think about now.
Okay, thank you. Anyone else? Okay, so as usual, Bruneians are really shy to talk. Anyway, that keep it up. This is a good habit. Keep it up, and but don't be shy in the exam hall. Try to reflect as much as possible. And let me repeat again. The information that I've shared with you, these are all still private. Okay, don't share with anyone. I mean, people should know eventually after the semester, but keep it to yourself. I wanted to clarify my position because later on you may hear it from someone that I left, and that may give you some bad impression about me. So I wanted to clear my position. This is the last class, and I won't have any other option to share this. Okay, all the best to you. I will. I wanted to, but if there is any possibility, let's say in the future, you want to look for me. So maybe you want to do a master's in the UK or in US. I don't actually know where I'm going finally, but I'll be able to give you a final maybe in February, January or February. So I'm not sure how to leave some traces of communication, but in the chat bar, I'm leaving you my personal email address, which you can use to communicate if you need any help. Because the UBD most probably will close my email address by the end of December for official or privacy or secrecy reason, because it's a government university, it's a government institution, so they will close the official email. So the private email I have shared with you, it's a Gmail, so you can drop an email, and if there's anything that you think you want me to help you with, or share anything that you have, I'll try my best. Okay, all the best to you. Thank you very much for your career. And about the test, if you have questions, drop me an email, or you can send me messages through Canvas. Okay, Assalamu alaikum and good morning once again.